Hi everyone, welcome to ACCA P6. Now in this video lecture, we are going to look at the tax reducers. When we made the income tax pro forma in our very first lecture, we divided the income into non-savings, savings and dividend. Then we listed down all the sources of income on the very left side. After doing all that, then we calculated the income tax liability according to the tax bands given to us on page number 1, and them bands will also be given to us in the exam paper. Alright, after calculating the tax liability, then we have reduced our tax liability. We can reduce our tax liability if we have invested in either EIS, SEIS or VCT. So there were three schemes which are tax efficient schemes, which are tax reducing schemes, whereby HMRC says that if you have invested money in any of these three schemes, and depending on which scheme you have invested, you will get some portion of tax reducer. Alright, so it depends. If you have invested in EIS, it is 30% tax reducer. If you have invested in SEIS, it is 50% reducer, whereas if you have invested in VCT, it is again 30% tax reducer. However, what are these schemes? So we will now look into details of tax reducers, that when we get these reducers, how we get it, and in circumstances when we will not get it, or if we have already got it, HMRC will take the tax reducers back if we haven't fulfilled the certain conditions. Alright, now before we move to this table which I have provided on the board, I will ask you to write down in a minute, but don't do it for now. I will move on one side in a minute, then you can note down what I ask you to note down. Alright, so HMRC said that if you invest in these companies, if you invest in these schemes, then you will get certain reliefs. Now what are these investment schemes? What are these? These are basically small businesses in the UK. So HMRC says that if you invest in small businesses in the UK, then you will get certain relief. Now not all the small businesses, but certain businesses which have registered themselves as EIS, SEIS or VCT companies. Alright, so basically these are small businesses. Why is HMRC doing it? Why the government of UK is doing it? Now HMRC says that, the government of UK says that whenever you are doing a business in the UK, then you are doing the benefit not only to yourself, because you are supporting yourself, you are also giving the benefit to the government in shape of paying the taxes. You're also providing some jobs as well to different people in the country, which is benefit to the different people and ultimately which benefits the government, right? Because it is the responsibility of the government to provide the jobs. Alright, so basically when you are doing a business in any country, you are not only supporting yourself, you are supporting a couple of other lads as well, maybe hundreds of them, depend on the level of business you're doing, and you are also paying the tax as well on your profits or value-added tax. So you are basically benefiting the government in many different ways, benefiting your own self, paying taxes, and also providing the jobs as well. So there are lots of benefits of doing the business. So that's why if you're a small investor and you cannot start the business, or you are reluctant to start the business, so that's why HMRC is giving some benefit. HMRC says, all right, okay, if you want to start the business, you cannot raise money, then you can register your business as EIS. You can register your business as SEIS or VCT companies. Then if you have registered yourself as one of these three companies, or either of these three companies, then you can raise finance from different individuals. Alright, so say for example, if I had small business and I have registered my business as EIS company, then my business is registered as EIS company, then different people within the country will be interested in investing in my company, in my EIS company. Why would they be interested in investing in EIS company? Because they will get the 30% tax reducer by HMRC. Alright, so basically that's why HMRC is saying that you invest in these companies, because HMRC want these companies to prosper, want these companies to grow up. All right. So basically, these the schemes, these EIS, SEIS, and VCT, these are basically companies which are small companies which want to raise the finance because they do not have enough money. So they want to raise the finance from the people within the UK so that they can expand their business. Alright, so let's look at this table now. So first of all, I've listed down on the top tax reducers. You can do so and make a table like this. Don't fill in yet, but just make the table like this. On top of that, I've listed down just beneath the tax reducers that tax reducers can only reduce the tax liability to zero it cannot reclaim the tax paid. All right. Now, say for example, if you have calculated the income tax liability, now after calculating the income tax liability, you have to reduce that income tax liability. Maximum you can reduce that liability is to 0. It cannot reclaim. We cannot reclaim the tax which we have already paid. So maximum we can reduce the tax liability is to 0. So that's what it says. All right. Now after writing that, this is the table. So list down tax reducer. So these are the names of the tax reducers here. Then it's the size of the company basically. Then it is risk, that how much risk is it if you invest in that company. Then it's maximum investment. So maximum investment, what amount can I do, can I contribute in this company? How much maximum amount can I contribute in this company to gain the relief, right? So that's what it is. Then it's minimum holding period. So there are certain conditions. You have to keep the shares of them company for certain period of time before you get the relief, right? So although that whenever you have invested in one of these companies, you will instantly get the relief. However, if you have sold them shares within a specified time, then HMRC will take the relief back. All right. So whatever relief you have already took, HMRC will take it back. So that's why you have to keep the shares for minimum period. Then it's a relief date given to us. Right. Then after that, relief rate is given. So at what rate you will get the relief? Then after that, CGT implications. So capital gains tax implications. Capital gains tax basically is another type of tax which we will see later. We are currently at income tax. So capital gains tax basically is another type of tax. But what will be the implications of EIS, SEIS and VCT in capital gains tax? We will see a little bit of capital gains tax as well. All right. Then after that, withdrawal of relief. Then in circumstances when you sell the shares and the relief which you already took, HMRC will take the relief back. So what are the circumstances? And after that, there is one note 1 here and one small example as well relevant to note 1. All right. So basically, whatever I told you, please make sure you note down them things. However, don't note down this middle stuff. When we talk through it, then you can note it down, and at the end of the example, you can pause the video and note down everything. But for now, just note down the stuff which I have just told you. This table here and top bit. So basically the headings. All right. Now I assume that you have already noted down. So basically these are the tax reducers. So enterprise investment scheme, which is EIS, then seed enterprise investment scheme, and finally the venture capital trust. So these are 3 schemes. Now basically, first of all, we will look at the size of the companies. That says what is the size of the enterprise investment scheme and what is the size of the seed enterprise investment scheme and the VCT. So basically the enterprise investment scheme is a small company. It's a small company which is unquoted as well. So basically it is unlisted company. Unquoted and listed, unquoted and unlisted is basically the same thing. So it is a small company, and obviously when the company is small, it won't be listed. So we won't expect the small company to be listed. So it is a small company and it is unlisted as well. Now there is another condition as well. It will have maximum of 250 employees. So if you have more than 250 employees, although you are unlisted and small, but you have more than 250 employees, then that company will not be IES company. So that will not be EIS company. So you will not be able to invest. I mean, you will be able to invest, but you will not be able to get the EIS relief. All right. So you must invest in a company which is a small company and which is unlisted as well. That company will have a maximum of 250 employees, so it will have less than 250 employees. And another condition is that it will have gross assets of less than 16 million pounds. All right. So there are certain conditions. So basically, this is the size of the company. So you will have to look at the size of the company, then you can invest it. And obviously, these things HMRC will have already seen these things before registering them companies as EIS, SEIS or VCT, right? So these are the conditions which them companies needs to fulfill. Although these conditions you must remember these conditions because it is often examined in the exam. All right. So basically that was EIS company. So it will be, what is it? It is a small company. It is unlisted company. Will have less than 250 employees. So you can imagine that company which have less than 250 employees, it will be a small company. Right, and it will have gross assets of less than 16 million pounds. So not a massive company, just a small company. All right, now looking at this information, just the size of this information, could you tell me that if a company which is a small company, which have merely 250 employees and which has less than 16 million gross assets, and which company is not listed as well? So what do you see? What do you think? That will that company be a risky company or not? I think just by looking at the company which is not listed, I would say it is a risky company. Right, so that's what it says in the risk section, that it is unquoted company, so that's why it is a risky company. Another thing to look for is that it has only 250 employees, so it has just started. It is not a massive company, so you will be reluctant to invest in this company because it is a risky investment. And another thing is the gross asset less than 16 million pounds. So basically it is unquoted company and it is a risky company as well because it is unlisted, so that's why it is risky. Right, so however, if after considering this stuff, we have thought that we will invest in this company, how much maximum investment can I do in this company to gain the relief? So maximum I can contribute in this company is £1 million in current tax year, which is 17-18. So I can invest maximum of £1 million to get the relief. Although I can invest more than that, but for current tax year, I will only be able to get the relief for up to £1 million. So if we invested £1 million, so 30% of that will be our relief of the EIS. All right, so that will be our tax reducer. However, if I have exceeded £1 million, so if I have, say for example, if I've invested £1.2 million in current tax year, then only 1 million in current tax year will be relieved. The other £200,000 it will be assumed to be invested in the previous year. So the relief will also be given in the previous year. So previous year was 16-17 because current year is 17-18. So say for example, if you have invested more than £1 million, only up to 1 million, the relief can be, the tax reducer can be availed in current tax year, whereas whatever the excess is, although we cannot do it in current year, but it will be assumed to be invested in the previous year. So the relief will also be given in the previous tax year. So the tax reducer will be given in the previous year of 16-17. All right, so that was our maximum investment which I can do. But hang on, I have invested in this company. Then I thought that how much, how long shall I invest in this company? How long shall I hold the shares of this company? So what about if I invest in this company today and after 6 months or after 3 months I have sold them shares? So I've already gained 30% relief. So if I've invested £1 million, 30% of that is £300,000. That is a massive amount in taxation. So if my liability, if I can reduce my tax liability by £300,000, that is a massive amount. Now after reducing that liability, I have held the shares for 3 months or couple of months, I don't know, or maybe for 6 months. After 6 months, I have sold the shares because the benefit of holding the shares was only to get the tax reducer initially. All right, so that's why after taking the tax reducer, I thought, why should I keep these shares? I will sell it off. No, if you sell it off, HMRC will say, give me the relief back, whichever you have already took, just give the relief back to me, right? So that's why you must hold these shares for 3 years if you want to keep the tax reducer. All right, so minimum holding period in this year, for EIS is 3 years. So if you have invested in enterprise investment scheme, you must hold these shares for 3 years. So a relief rate basically is 30%, as we already know. So whatever amount you have invested in EIS, we'll take 30% of that. So that will be our tax relief under EIS. Now what are the CGT implications? Capital gains tax. What is capital gains tax? Whenever I sell something, I will take the sales less cost. That is our capital gains tax. So in simple terms, it's like that. We will see the complicated stuff when we move to capital gains tax, but assume, say for example, if I had if I had a piece of land and I sold that piece of land for £100,000, I bought it for £50,000. How much is the gain? £50,000. So that is basically capital gains tax. All right. Likewise, if I held the shares in the EIS company, whenever I sell the shares of EIS company, so whatever amount I have sold it for, that will be my sales. Whatever amount I have bought it for, that will be my purchases. The rest of the amount, the net amount, will be my capital gains. All right. Now, what are the capital gains tax implications? So that was normal treatment of shares. So what if these are the CGT, these are the EIS shares? What would happen? Now, if you have sold after 3 years, then you will not have to pay any capital gains tax at all. Just like in the normal case, because you have held the shares for 3 years and you are selling the shares after 3 years, because minimum holding period was 3 years anyway. So if you have sold the shares after 3 years, you will not have to pay any capital gains tax. However, if you have sold the shares within 3 years, it says normal CGT. So normal CGT calculation is basically whatever amount you have sold it for. So you'll take the sales less whatever amount you have bought it for. Whatever the net amount is, that will be our capital gains. All right. So if you have sold the shares, if you have sold the if you have sold the EIS shares within 3 years, then the CGT implications will be you'll have to calculate the CGT according to the normal CGT rules. All right. Now, if you have, for example, sold the shares at loss, so you have bought the shares at expensive price, but the share price has fell a little by the time you have held it, then what would happen? Because you have incurred a loss, then how to treat that loss? Now, it says note 1 here. So note 1 I have mentioned here. So we will look at the note 1 later. But for now, that was it about the EIS. Only for withdrawal of relief. Now, withdrawal of relief is exactly the same for EIS, SEIS and VCT. So there is just one single rule for which applies on all of these. So basically, when you have sold at market value, say for example, if you have sold the shares within 3 years or within the minimum holding period. So the minimum holding period in EIS was 3 years. If you have sold the shares within the 3 years period, HMRC will withdraw the relief. Now, how it would withdraw the relief? If you have sold the shares at market value, then we will take the market value multiplied by the tax reducer rate. So what was the rate in EIS? 30% was the tax reducer rate. So that's how the that's how the withdrawal of EIS relief will apply. All right. So if you have sold at the market value, what if you haven't sold at the market value? So what? Say for example, if you have held the shares for some time and you have sold it after 2 years to your daughter. So of course, whatever the market price was, you will not sell your daughter at the market price. You will sell at less than market price. Or if you give it for free, say for example, then it is assumed at less than market price. So if you have sold less than market price, or if you have sold for free to your relative, then all the relief originally obtained, all the relief is withdrawn. So whatever the amount of relief which you originally obtained, whole amount of relief will be withdrawn. In what circumstances? In a situation where you have sold it less than market value. However, if you have sold it at the market value, then whatever the market value you have sold it for, multiplied by the rate of relief. So rate of relief in EIS was 30%. All right, so that's how it works. So that was withdrawal of relief. So that is EIS. Let's look at the seed enterprise investment scheme. All right, so that is the second scheme, seed enterprise investment scheme. Let's look at the size. Now, seed enterprise investment scheme. Before we move to seed enterprise investment scheme, could you please tell me what was the size of EIS? Could you please remind me without looking at the board? So what was the size of the EIS? EIS was small company, EIS was an unlisted company. Likewise, this is also a small company. It is also an unlisted company. So what's the difference? This seed enterprise investment scheme is even smaller, very small, a tiny bit of company. And it is unlisted as well. So it is a small company, unlisted company with maximum of 25 employees. All right, so what was the number of employees maximum allowed in EIS? 250 employees, whereas in SEIS just 25 employees. So you can imagine a company with only 25 employees, what would be the size of that company? Just tiny bit of company, very small company. And gross assets of less than 200,000 pounds. So basically it is a very, very small, tiny bit of company. So by looking at the size, what would you think? How risky is it to invest in that company? Very risky, I would say, because it is an unquoted company, very small, so hence very risky investment. All right. So because it is very risky investment, HMRC says, I will give you more relief. All right. So that's why the percentage rate of relief in this case is 50%, because you are taking more risk. So if you're taking more risk, HMRC says we will give you more relief in this case. Minimum holding period in this case is 3 years as well, just like EIS. And maximum investment in SEIS, because the 50% relief, we will only be able to invest £100,000, unlike £1 million in EIS, we will only be able to invest £100,000 in seed enterprise investment scheme. However, if you have invested in excess of that, that excess will be considered to be invested in the previous tax year of 16-17. All right, again, in the previous tax year as well, maximum will be £100,000. All right. Right, so apart from that, risk, we have already considered the risk anyway, so tax rate will be 50%. So CGT implications, so basically when you have sold the shares of SEIS company, when you have sold the shares and the proceeds which you have received after selling, the money which you have received after selling, if you reinvest again in SEIS shares, then 50% relief will be available. All right, so if you have invested, if you have reinvested in the SEIS company, then you will again get the 50% relief of CGT. All right, so basically not again, we're talking about the CGT. So basically if you have reinvested, then you will get the 50% relief. All right, so next is the withdrawal of relief. As I said, withdrawal of relief, rule for withdrawal of relief is exactly the same in all three cases. So if you have sold the shares, within the minimum holding period, so minimum holding period in this case as well 3 years. So if you have held the seed enterprise investment shares and you have sold within 3 years, then HMRC will withdraw the relief. How will it withdraw? It depends on if you have sold it at market value, then we will take the market value multiplied by the rate. What is the rate in this case? In this case, it will be 50% rate. All right, so market value multiplied by the rate. And if you have sold it not at arm's length, now market value is sometimes known as arm's length. All right, so if you have sold at arm's length, that is market value. If you haven't sold at arm's length, that is not sold at the market value. Right, so if you haven't sold at market value, say for example, if you wanted to give it to your daughter or son, then you will likely, the chances are that you will not sell it for market price, you will sell it less than market price. In that case, all of the relief which you originally obtained, all amount of relief will be withdrawn. Right, so that was a withdrawal of relief. So last scheme in this case is venture capital trust. Right, now them were the individual schemes, then enterprise investment scheme and SEIS, these were individual companies, all right, on its own. Whereas this one, venture capital trust, like the name says, it is a trust. All right, so it is basically a trust which raises the money from individuals, from many individuals. So it raises the money from many individuals and then it invests in EIS and SEIS. All right, so I hope you would appreciate the fact that it is a separate company and now they have made up a company, so which is a trust. Now that trust raises the money from all over the UK. All right, then after raising the money, it again invests in them companies, EIS and SEIS. All right, so what's the difference then? If I am investing in VCT, instead of investing in VCT, I should invest directly in EIS or SEIS. All right, so why would I invest in venture capital trust? Is there any encouragement? Yes, because it is listed. Venture capital trust is listed in London Stock Exchange, which means it is less risky investment than EIS and especially than SEIS. All right, so venture capital trust is basically listed trust on London Stock Exchange, which raises the money and then invests in EIS and SEIS type companies. All right, so it is listed trust, invests in EIS, SEIS type companies. So that is the size of the company basically. That is only information available to us, and that is only information relevant as far as P6 is concerned. So how risky is it? It is listed, so moderately risky, not as risky as EIS or SEIS because it is listed on London Stock Exchange. Maximum investment allowed is £200,000 in current tax year. If I have invested more than that, then it will be applied in the previous tax year of 16-17. Hang on, minimum holding period in previous two schemes was 3 years, whereas I have to hold these shares for 5 years in this case. So these are extra 2 years, so you need to be a patient person. So you'll have to have patience if you want to keep the shares of venture capital trust, because 5 years is a a lot of time. So you'll have to keep the shares for 5 years. And despite of the fact you are keeping the shares for 5 years, you will only get 30% relief. All right. So chances are you might compare these two schemes, EIS and VCT, because you are getting 30% here and there as well. However, you're only investing for 3 years in that case. I mean, your minimum holding period is 3 years in EIS. And again, when you started to think about EIS, then you might become a little greedy. You will say, I'm holding these shares for 3 years and these as well for 3 years. Why shouldn't I invest in SEIS? Because the relief in SEIS is way more than that, 50% relief. But after you have made up your mind that I'm going to invest in SEIS, then you thought, oh my God, let's look at the size of the company. It merely got 25 employees, so it is far more riskier than venture capital trust. Then you made up your mind that I will invest in venture capital trust. So, all right, so you came back to venture capital trust. Right. So what are the CGT implications? So there will not be any capital gains tax in venture capital trust. All right, so that is a good news, that you will not have to pay any capital gains tax. Losses are not allowable. So if there is any loss, it will be assumed that no loss, no gain. All right. And dividends are tax-free. So say, for example, if you hold the shares in venture capital trust and that trust pays you any dividend, you will not have to pay any tax on the dividends which you receive from VCT. All right. So that was it. And withdrawal of relief, again for VCT as well, it depends on if you have sold it for market value within the specified holding period, which in this case is 5 years. So if you have sold within 5 years, you have the shares in VCT, you sold within 5 years, and you sold at market value, then we will take the market value multiplied by the rate. Rate in this case is 30%. And if you have sold at less than market value, then the whole amount of relief will be withdrawn. Right, so these were tax reducers, EIS, SEIS and VCT. Only thing left is here, note 1. So what was note 1? So we were considering that if you held the shares in EIS company, and what would be the CGT implications. All right. So CGT implications, if you held the shares for EIS company and now you are selling the shares. If you are selling the shares after 3 years, say for example, then you will not have to pay any capital gains tax because you have held the shares for minimum holding period. So there will not be any capital gains tax. However, if you are selling the shares within 3 years period, then there will be normal CGT implications. So you'll take the sales, less the cost, net amount is going to be your capital gain. The problem arises when you have sold the shares at loss. All right, so that's what we are now looking at. So if you have held the shares and you have sold them, shares at loss, what would happen then? Right. So note 1, sold the shares at loss. So we are looking at EIS shares, and what would be the CGT implications? So I've listed down one question here. So Mr. Z, who invested £10,000 in EIS company here. So Mr. Z invested £10,000 in EIS company and sold the shares after 4 years for £5,000. What are CGT implications? All right. Now, a rule to calculate this question is listed below. So it says that loss is allowable, but cost of shares will be reduced by EIS relief obtained. All right. So loss is allowable. So if there is any loss, it will be allowable, but the cost of the shares will be reduced by EIS relief obtained. All right. So let's calculate this question. Let's do this question. So what would be the initial? So tax reducer. What would be the initial tax reducer? So tax reducer will be amount invested, which was £10,000 multiplied by 30% because it is EIS, and he held the shares for minimum holding period 3 years. But even if he did not hold the shares for 3 years, he will still get the tax reducer anyway, but that tax reducer will be withdrawn if he did not hold the shares within the if you did not hold the shares for 3 years period. All right. However, this loss treatment which we are going to do now, it is regardless of how long you hold the shares for. Now, even if you sell the shares within 3 years period or more than 3 years period, the treatment of the loss will be exactly the same. All right. So the initial treatment was that we'll get the 30% relief. So Mr. Z got the relief of £3,000 initially. Then what happened is that he sold the shares at loss. So what would be the CGT implications? So we took, so we'll calculate the CGT. So we take the sales of it. So what was the sales? How much did he sold the shares for? He sold the shares for £5,000, whereas he bought, so the cost of shares which he bought was how much? Cost was £10,000. So hang on. So cost was £10,000. So we'll write down the cost here, which is £10,000. Now this cost will be reduced by the relief already obtained. So how much was the relief? So relief will be obtained. Relief will be withdrawn. So 3,000 of the relief which he already obtained. It will reduce the cost. So the remaining cost here will be £7,000. All right. So how much is the loss now? £2,000 is the loss. So what does it mean? That loss is allowable, but cost of the shares will be reduced by the relief originally obtained. Now please read the rule again now. It says that loss is allowable, but cost of shares will be reduced by EIS relief obtained. So that's how it works. So if you've held the shares in EIS and you have sold them shares even within the 3 years period or after 3 years period, but you have sold the shares at loss, then this treatment would apply. So you will take the sales and you will take the cost. That cost will be reduced by the relief which you originally obtained, which will make it to the loss of whatever amount. In this case, it is £2,000. All right. Now, if there would not be any loss, then we will create it again. But what does it mean is that loss is allowable. So if it said that loss is not allowable, if it would have said that loss is not allowable, like in this case it says loss is not allowable, then what we would have done is 5,000 minus 7,000 is equal to 0. 0 means no gain, no loss. All right. So that means loss is not allowable. Whereas when it says loss is allowable, it means that loss is allowed. So we will create the loss here. Loss allowable simply means that if you have a loss now, in the future year periods, if you make any gain, that loss will reduce the gain of the future year, and which eventually will have to pay less tax in the future. But don't confuse yourself with this now, because this is the only thing which is relevant as far as these schemes are concerned. We will look into the details of capital gains tax when we move to that section. However, we are at income tax for now. All right. Now, if you want to pause the video and note down everything I've written on the board, that's the time to do now. If you have noted down earlier, then you are not so obedient student. You are not following what I said. All right. So please make sure you note down whatever I've written on the board. Right. So if you have already noted down, the good news is that this same stuff is already given to you on your lecture notes, chapter number 2, page 8 and 9, I think. If not 8 and 9, 7 and 8, I think. So from 7 to 9, these schemes are given on your lecture notes of P6. All right. So that is a good news. Now you would say that why did you ask us to note down when it is already given to us in the notes? Because it will help you in revision, and it will make your concepts more stronger, because obviously if you just read from the notes, it is less effective. If you write it down and then read it, it is more effective. All right, so that's it for now, and I will see you in the next video lecture, and we will continue with P6 UK version. Goodbye.